Welcome to Inside India. I'm JP Ong, and here are your headlines. India's foreign ministry says it is not aware of any phone call between Prime Minister Narendra Modi and U.S. President Donald Trump over Russian oil, stressing there should be no double standards in energy trade. The Indian rupee trying to close out the week on a firm note after a bout of central bank buying helped to prop up the currency towards a one-month high. And don't look now, the gold rush continues as the precious metal soars past $4,300 to another all-time high. Happy Friday, and ahead of the start of the last trading day of the week out in India, we take a look at how Asian markets are trending. And while gold is glittering, you can't say the same for regional equities from Tokyo to Taipei and mostly flashing varying shades of red. The one standout perhaps is the Kospi, just keeping its nose above water at 3,751 points. Meanwhile, the Nikkei 225 down by about 0.9% in today's session, also matching declines for the Shanghai Composite and the Hang Seng out in Hong Kong. A lot of the uncertainty perhaps coming after Wall Street itself took a step back on concerns about regional banks and their solvency and safety with regards to that sector, really once again casting a doubt over the world's largest economy. That has cascaded towards equities, not just there, but also over here in the Asia Pacific. And of course, all of this setting up the Indian markets, which are set to come online in about 44 minutes. We take a first snapshot of how GIFT Nifty futures is now trending, and we are seeing that they are keeping the faith and trading about 21 points above Thursday's close. Now, mind you, they are on 2 straight days of gains and actually closed strongly at 25,585 points. But perhaps the story right now is the recent flexing of the confident rupee, which has clawed back some significant ground against the U.S. dollar. It's currently now sitting, though, at just about 88 against the U.S. dollar, so perhaps giving back some of those gains and softening once again after 2 days of impressive strength on the back of indications that the central banker, the RBI, is buying back the rupee to prop up and perhaps smoothen out some of the volatility in the FX space. There's also a lack of clarity on U.S.-India trade talks. The White House is saying productive discussions with India have led to the country cutting its Russian oil imports by 50%. But ahead of that, India's foreign ministry said it was not aware of a phone call between U.S. President Trump and Indian Prime Minister Narendra Modi on Wednesday. The comments follow Trump's remarks that Modi has reassured him that India will stop buying Russian oil. CNBC TV18's Parikshit Luthra is with us right now and has the latest. Parikshit, thank you so much for joining.
India and the United States have made positive progress on the trade negotiations. Sources say the commentary by both US officials and Indian officials has been positive so far, but we're not there yet as far as a trade deal goes. Both sides are yet to agree on an average tariff rate. The effort, we're told by sources, is to find one landing zone or one trade deal which addresses both the penalty tariffs of 25% due to India's purchases on Russian oil and also the reciprocal tariff rate of 25%. Whether we have one comprehensive trade deal or not, that remains to be seen. However, the negotiations between both sides have been progressing well and they are gathering pace. India's chief negotiator Rajesh Agrawal is in the US now for the next phase of negotiations. But there are still sticking points related to automotive tariffs, agriculture, dairy, quality control orders in India and non-tariff barriers. US companies are also seeking a level playing field in the e-commerce sector. As far as the oil trade is concerned, the President of the United States has claimed that the Indian Prime Minister has assured him that India will stop buying Russian oil. Now, India in a statement has said that they're not aware of any conversation between Prime Minister Modi and President Trump in the last 24 hours, but they are committed to diversifying energy supplies and also ensuring secured and stable prices for Indian consumers.
I am not aware of any conversation yesterday between the two leaders.
They've also said that India and the US have been working to expand the energy partnership, and we are welcoming more oil trade with the United States as well. We're told by sources that India's oil imports from the US have already touched $8 billion, which is 60% up year on year, and they may actually reach $12 or $13 billion by the end of this year. And for this entire fiscal, it may be around $24 to $25 billion. This, many Indian officials believe, will itself address the $45 billion trade deficit with the US to a great extent. Next few weeks are going to be crucial as far as the trade negotiations between India and US go.
Meanwhile, a senior Indian government source told Reuters that any shortfall in Russian oil supplies could potentially be replaced with imports from the United States. But the source warns if India and China halt purchases from Moscow, it will drive up global oil prices and fuel volatility. Russia's Kremlin also weighed in, saying it trusts both India's and China's official statements on their oil trade and President Trump's recent remarks. Trump had said New Delhi is facing 50% tariffs from the U.S. due to its purchases of Russian oil. Meanwhile, the IMF is banking on India's strong domestic momentum to offset the impact of steep U.S. tariffs this year, but expects them to still hurt the growth engine in some ways in the next fiscal. CNBC's Karen So spoke to the fund's APAC director Krishna Srinivasan about this. Here's what he had to say.
Just to give you the headline numbers, this year we have India growing at 6.6%, slowing to 6.2% next year. Why do we, and this is an upward revision to our forecast for this year, so 6.6%, we had 6.4 earlier. The reason being that, yes, tariffs have been a headwind to growth. At the same time, the first quarter numbers in India came out very strong, much better than what we'd expected. And they've also undertaken some very serious domestic reform. The GST reform is good. So there are some couple of tailwinds which kind of offset the headwinds. That's why we revised up our numbers for India. But for next year, we revise it down because we assume it's a 50% tariff, right? So to the extent that that deal is being negotiated, there are still negotiations ongoing between India and the US. If those come out better, then there's much more upside potential to India's growth.
Well, let's move on to some earnings. And we saw contrasting results from Eternal and Nestle India, offering a snapshot of consumer appetite ahead of the festive season. Eternal, the parent company of Zomato and Blinkit, posted a sharp rise in quarterly profit up to 650 million rupees. This compared to the 250 million in the previous quarter. Still, margins at Eternal remain under pressure as Blinkit continues to spend heavily on marketing and store expansion, now targeting more than 2,100 locations in December. Its adjusted loss at Blinkit narrowed slightly to 1.56 billion rupees, though it missed analyst forecasts. Meanwhile, Nestle India delivered steadier results, reporting a modest rise in second quarter profit to about 10.3 billion rupees as urban demand for Maggi noodles and Nescafe coffee picked up. Revenue climbed more than 10% and shares rose to about 5% to a one-year high in the previous season, lifting the nifty FMCG index. Managing Director Manish Tiwari said domestic sales hit a record high as Nestle rides the wave of rising disposable incomes and festive spending. India's quick commerce startup Zepto has raised $450 million in fresh funding, pushing its valuation to $7 billion. The latest round brings its net cash reserves to nearly $900 million. Zepto competes with rivals Blinkit and Swiggy Instamart and is preparing for a stock market listing. The funding round saw participation from new and existing investors, including CalPERS, General Catalyst, Goodwater Capital, and Lightspeed. Urban consumers are driving growth in the sector with demand for groceries and essentials delivered in under 10 minutes, which is expected to spike during the busy festive period. And this festive rush is also fueling gold prices in India. Local prices hit over 128,000 rupees per 10 grams this week. Reports are also suggesting smuggling of the precious metal into India is spiking ahead of Diwali. Customs officials report more seizures at airports as record high prices and tight supplies fuel this gray market. Premiums on official prices are now the highest in more than a decade. And while we're at it, we take a look at spot gold now trading this way, and we are seeing that there is the continued march upward shows no signs of abating, now at $4,346 per troy ounce, up about 0.5% intraday. And right now, if you go back for over the last 12 months, it's now up more than 61%. Well, let's take a closer look now at how consumption is being shaped out in India and whether or not the rush in terms of consumer sentiment and the uptick in consumer sentiment will be fueling earnings effectively. George Heber Joseph is the CEO and CIO of Ask Investment Managers. He joins us now today to talk about that very thing. We're coming to the tail end of the festive season, actually, sir, and we've seen on the ground. I just want to know what you've seen on the ground with regards to how robust demand and consumption has actually picked up due to some of the GST reforms and some of the efforts to try and at least unleash more of the animal spirits among the Indian consumers.
Thank you. Yes, there is a strong sense of optimism this year. The festive season in India generally is a time of celebrations, sentiment booster, and also a growth catalyst. So when I look at from that perspective, the confluence of strong consumer confidence, easing inflation, and also the rising disposable income is clearly visible in this festive season. When we talk into the details, there is good amount of jewelry purchase, housing, as well as white goods and cars and two-wheelers significantly on stock out situation at this point in time. So a very, very strong start we could see after a long lull period.
George, I wonder if there is a difference, though, if you could help us understand if there's a difference between consumption trends in the urban and rural sectors of India, because some are actually pointing out that you have to be clear as to which part of India you're looking at. Is there any clear divergence or perhaps a difference in how Indian consumers in the urban metropolises are approaching this confidence versus, say, some of the rural counterparts?
So when you look into the details, what is clearly coming out is the two-wheeler purchases also, specifically driven by rural and urban, but more to do with the rural, and that is picking up very fast, and that is a good sign. The tractor purchases is increasing, which is again a rural folks driven, consumption, and also we are seeing the consumption across board in consumer durables and electronics, not only from the urban folks as well as from the rural as well. So FMCG, auto, consumer durables and electronics, and there are talks about real estate and home improvement also picking up very fast. All put together, it is a broad-based, consumption story, driven by rural as well as urban.
All right, George. The big question, though, here, I believe, is will all this demand result in a significant earnings boost? And some argue as to how quickly the earnings transmission is actually for Indian markets and some of the corporates listed out there. Can you give us an idea of which sectors might see a stronger and more immediate impact from this consumption boost that you're documenting when earnings season, both now and in the future, actually rolls around?
If you look at in the recent past, a lot of actions from the government as well as the central bank, the rate cuts, 100 basis points interest rate cuts over a period of last 1 year, and also the cash reserve ratio also has been brought down, which actually flows into the system in terms of the growth opportunity. And also, if you look at from the perspective of GST cut, which has been recently announced by Mr. Modi, and that also is increasingly benefiting a lot of consumption patterns. So it is a host of activities, and also again, Eighth Pay Commission is coming on board, and that also will have a booster effect on the consumption story, especially in the two-wheelers and four-wheelers. So we are seeing that all the actions which we have seen in the last few quarters, it is going to benefit, and the results are there. The festive season is started very strong, and we are seeing the sentiment all across in the urban as well as rural. Now, when you look at some of the reasons why we were waiting for this entire fillip of growth, the GDP was always going strong, but at the same time, the earnings growth was slowing, as you were rightly mentioning. But what we strongly believe is that the sectors which are more of GST beneficiaries will be the first one to react, and that will be autos, and also to a certain extent FMCG sector, and also you will see a good amount of improvement, home improvement, which will also kick in during this festive season, which will benefit cement consumption and so on and so forth. So all these put together, we believe that it will flow into the banking system, and the banking credit growth also will start inching up. The user industry is getting more orders, which means that the capex in some shape or form will kick in the private capex space, which already been started, but you will see stronger growth coming in. So it is a wholesome recovery phase in H2 what we are expecting, and banking sector, which is especially the private banking space, which is deeply in a consolidation phase, we think that there is a good amount of growth possibility. So autos, banking, cement, and some sort of consumables and engineering and capital goods and real estate will be the ones which will be on the focus, according to me.
And what about financial services? I'm thinking about, say, those who provide insurance, brokerages, or even wealth managers like yourselves. I mean, some say that because of the higher disposable income, it might actually give more people room for savings and investment. Have you seen an uptick actually in your day-to-day operations? Are people asking, pun intended, for more of the services provided by groups like Ask Investment, for instance?
Absolutely right. The last 1.5 years, market has not gone anywhere. And if you see, there is a significant amount of consolidation which has happened. And because of which, people who have been waiting on the sidelines started asking that, where should we invest and, what should be the modus operandi of investing into equities. And what we have been saying is that there is a good amount of attractive valuation visible in the large cap space, and also the capital market theme, as you rightly pointed out, is in a massive tailwind is visible for the next 10 years or so, and there is a huge amount of money going to flow in the capital market. Focused businesses, especially the wealth management and asset management businesses, will do significantly well. And the beneficiaries of that are exchanges and, depository participants, which we think, is going to be a long-term structural themes to play. And alongside, you're seeing on the CapEx revival stories, specifically with regard to the defense-led CapEx, which also attracting a lot of attention from the government, and the orders are flowing through. So there is a good amount of CapEx cycle recovery on side is happening. At the same time, the consumption boost will add to the private CapEx story as well. Because last 5 years is more of a public CapEx, which will change to, the public plus private CapEx. So we are estimating that, there is a full-blown recovery phase coming through. And, most of the sectors, the cyclical sectors, domestic-oriented cyclical sectors, going to benefit materially, consumer discretionary over staples, and, and we believe that it will flow into the banking system, so which will be big beneficiary, and financial services, obviously, it will be under the radar.
So autos, FMCG, and in some ways banking and financial services, those are some of the sectors to watch out for. George, I'm curious because we actually had a guest just the other day from Eastspring, and portfolio manager looks at India, and she did stress that while there is upside for the Indian markets, you have to look beyond the themes and you have to look beyond the headlines, actually. Basically stressing that identifying sectors is not enough because you'll have to be also a bit more meticulous when you're trying to identify certain stocks if you want to dig deeper. For investors who might want to dig a little deeper and actually identify winners within these sectors, how would you advise them to approach that and make sure that they're identifying companies that can benefit from these long-term trends that we've actually identified?
Absolutely right. So India is in a growing market and is one of the fastest growing market in the world, and which has a potential of the strong demographics. The fiscal is very strong. Government actions are very strong. So there is a huge amount of optimism automatically kicking in. And when you look at various sectors which are the beneficiaries from the structural demographic themes, auto, FMCG, pharmaceuticals, and banking sector becomes extremely important because these are all B2C plays and which has a good amount of very strong companies, proven track records visible in these sectors. When you when you wind back and see that some of these government actions which are also adding to the tax collections, and this GST rollback, and some of the actions also, which means that the volumes will kick in and the GST collections can actually inch up and probably hit all-time highs. So, and alongside, it will drive employment and informal incomes. So, to my mind, there are many sectors to be looked at, especially the banking sector looks banking and financial services sector looks the most attractive bet. I cannot take stock names per se, but at the same time, cement sector looks very interesting because it is connected to the real estate, the home improvement, the luxury real estate is affordable, also is improving. And also you are seeing that, specifically the domestic oriented cyclical sectors like auto and other
Right.
discretionary spending and aspirational spending is increasing substantially. So many pockets to play, hospitals, hotels. There is a
Okay.
bunch of ideas in different sectors which is linked to the domestic economy to play.
Okay, George. George. Now let's shift from domestic to something more global now, because as we head out of the festive season in India, we're now focusing on the U.S. holiday season. Of course, that puts a lot of Indian exporters that might be facing higher U.S. tariffs under the spotlight. Is there a risk actually that they might see their earnings impacted significantly in this U.S. holiday season because of the higher tariffs? What are your thoughts with regards to what you might be tracking with regards to these exporters that might be vulnerable?
That's right. If you look at this is a shift in a decade, what I would call it, from 2020 when the inflation and interest rates bottomed out in US and when it started inching up, inflation protection sectors like real estate, commodities, in engineering, capital goods, and also the utility sector did the best. If you come look at from the Indian context. And these are the sectors, which will do well in the future as well, and especially the financials also, the some sort of beneficiaries in that regard. So it was a marked shift from the previous decade where the consumption was 2010 to 20 was the consumption story, and first decade if you see 1990 to 2000 was
Right.
a TMT, technology media telecom story. So I believe it's a
Okay.
decadal shift which has happened in 2020, and we are going to see significant amount of growth in these sectors. And the exporters, as you rightly mentioned, will struggle, and also many of these export oriented businesses which are facing the challenges of tariff
Right.
as well as challenges on the pricing will be on less of reckoning at
Okay.
this point in time.
All right, fascinating insights. George Hebert Joseph, CEO and CIO at Ask Investment Managers. Thanks for letting us ask you the questions that are pertinent with regards to India's festive season and some of the tariff risks facing some of their exporters. Well, coming up, India is still in the line of fire when it comes to Russian oil. We'll talk about new sanctions and efforts of diversifying energy supplies after this short break. Stay tuned. Welcome back to Inside India. The United Kingdom is tightening energy sanctions on Russia, targeting Lukoil, Rosneft, 44 shadow fleet tankers, and India's Nayara Energy, which is a Rosneft-owned Mumbai refinery. Finance Minister Rachel Reeves says pressure will also mount on companies in third countries, including India and China, that continue to move Russian oil. Analysts warn that the measures could disrupt India's crude supplies, even as Nayara struggles to keep operations running. India's foreign ministry, meanwhile, urging no double standards on energy trade as some Western nations continue to buy Russian gas.
We have noticed the latest sanctions announced by the UK. As I have said this earlier as well, and possibly most of you are aware of it as well, that we do not subscribe to any unilateral sanctions. Government of India considers the provision of energy security a responsibility of paramount importance to meet the basic needs of its citizens. Indian companies source energy supplies from around the world while taking overall market conditions into account. We would stress that there should be no double standards, especially when it comes to energy trade.
Meantime, Brazil's state-run oil company Petrobras says it will sign a contract to supply over 6 million barrels of oil to India. Brazilian Vice President Alckmin confirmed the deal during his official visit to New Delhi on Thursday. This is as India looks to diversify its own energy imports. And during his visit, Brazilian Vice President Geraldo Alckmin met with the Indian Minister of Commerce and Trade Piyush Goyal at an event. Goyal said India is working to expand its preferential trade agreement with Brazil to penetrate the South American market in a bigger way. Both countries are pushing to lift bilateral trade to over $20 billion by 2030, up from just about $12 billion last year. Well, coming up, India's IT sector is wrapping the earnings report cards with a strong second quarter. Is this the beginning of a recovery, or will new policy changes in the U.S. continue to weigh on the sector? We'll discuss this shortly after a break. Welcome back to Inside India. Let's take a look at the U.S. dollar, which is under pressure and on course for its worst week in about 2 months. Take a look at the dollar index now starting to just continue that decline by about a tenth of 8%. U.S. Treasury yields also sitting lower than they did a week ago, with Fed Governor Christopher Waller saying he would back another rate cut in October, citing some softening in the labor market. But anything beyond that would continue to be data dependent. Speaking in New York, Waller said he was focusing on employment figures and any tariff impact on inflation. Meanwhile, the Fed's newest governor, Stephen Miron, continued to argue for more aggressive rate cuts, citing renewed U.S.-China trade tensions as a risk. With the lack in government data due to the ongoing U.S. government shutdown, investors and policymakers have been looking at private numbers. It makes the Fed's job going into this month's policy meeting a lot trickier. Now, we did get some regional data. The Philadelphia Fed survey of manufacturing activity unexpectedly sank into contraction to negative 12.8 in October, a 6-month low. And speaking of other risks, regional bank stocks also down sharply in the Wall Street session, dragging the S&P lower. Zions Bancorp sinking 13% after saying it would take a $50 million hit on 2 commercial and industrial loans in its California business. Separately, Western Alliance also down by a similar quantum after disclosing it initiated a lawsuit against Cantor Group on fraud allegations. Investment bank Jefferies also plunging 10% as it revealed exposure to bankrupt auto parts maker First Brands. We're still counting down to the market open in India in about 13 minutes, and this is how things are shaping up. A final check on Gift Nifty futures, and there's still foreshadowing slight gains of about 18 points. Mind you that the Nifty is on a 2-day winning streak and continues to look quite strong, and the Indian rupee has gone back to winning ways against that softening dollar. The Indian rupee strengthening to about 87.77 against that greenback, and likely dollar selling by the RBI, the reason why the rupee is also finding a bit of a boost. Focusing on the IT sector, though, today, we got earnings from Infosys and Wipro yesterday. First up, let's take a look at Infosys, narrowing its revenue growth forecast to 2 to 3% for the year amid a challenging macro environment. But its ADRs on the New York Stock Exchange still plunged 4% in trade after the report and recovered some losses later. Infosys saw sales rise 8.5% on year to around $5 billion, beating analyst estimates. Its financial services and manufacturing verticals performed strong in the last quarter. A similar session for Wipro's ADRs, that's despite the IT major beating revenue estimates with around $3 billion in quarterly sales, driven by growth in Asia and the Americas. The company secured mega contracts worth more than $500 million each with Phoenix Group and a U.S. telco client. And other smaller IT firms, including LTI-Mindtree and Persistent Systems, showed a similar trend of upbeat results. LTI-Mindtree, for example, reported strong bookings and steady growth, while market analysts note that smaller and mid-tier firms are benefiting from enterprises shifting budgets toward automation, AI, and efficiency-focused initiatives. Last week, market leader TCS and HCL Tech, too, also made a strong showing, beating earnings estimates. The broader $283 billion sector is showing signs of that recovery. Financial services clients, in particular, are driving renewed demand, supporting both revenue growth and deal momentum across the industry. The broader Nifty IT index is seeing some semblance of a recovery as well. Part of that plunge in the Nifty IT index you saw came when the U.S. announced regulations around H-1B visas. Most of these companies see the U.S. as one of their major markets, with a hiked visa fee now forcing these firms to hire more local. Here's what Wipro had to say on the matter.
Today, nearly 80% of our U.S. employee base are locals. We believe that with the change in the H-1B program, from a business impact will be very limited. We have enough and more avenues to manage the change.
But a major U.S. business group is warning that this new fee could force companies to cut hiring or raise their labor costs sharply. The U.S. Chamber of Commerce is suing President Trump over this, calling it beyond his authority and disruptive to the visa system. The lawsuit joins at least one other legal challenge in California's federal court. Let's talk more about the broader IT sector on the back of some of these headwinds and the recent earnings results. We're joined by Sumit Jain, who is the Senior Research Analyst at CLSA India. Sumit, thank you so much for joining us today. We've gotten enough report cards out right now, and I just wanted to get an idea of how the earnings of these IT services providers in India, how they stacked up against CLSA's expectations. Because if I'm not mistaken, the expectations heading into this earnings season was we were going to see a trim in growth, actually, or moderation in growth from some of these IT providers. Did it meet, or did it actually surprise you on the upside?
No, thanks for having me on your show. And I think clearly in a very weak setup for the result season for IT sector, most of the companies reported a beat on their top line growth, where we could see now the tariff impact is only visible probably in retail and autos vertical. But rest of the sectors saw a good sequential growth this quarter. So clearly, if you look at the top line growth of almost every large cap as well as the mid cap IT service companies who have reported till now, it have all been better than what we and the street were expecting. And also to highlight, INR depreciated very sharply against US dollar last quarter, also because of increased tariffs imposed by the US administration. And INR depreciation, as you know, helped exporters, all these IT service companies. So that helped expand their sequential EBIT margins by around 40 to 60 basis points. So clearly, I guess after a span of 6 to 9 months, we are actually seeing the earning estimates on the street from next 1 year forward standpoint to actually move up. And the companies who give the annual growth guidance, like Infosys and HCL, either maintained that guidance or upgraded that the way we saw in case of Infosys. So yeah, I think it's still pretty early days. You can't conclude that discretionary demand has revived across sectors. The overall demand environment still remained cautionary, and most of the companies are expecting good days ahead if the US Fed rate cuts are more aggressive than what Street is currently building in.
Sumit, earlier on, we actually took a note of one interesting trend, actually, and that seems to be that the mid-sized IT services companies seem to be performing a little bit better as compared to some of their heavyweight peers. Do you think that's a credible trend that should be taken more note of? And is this perhaps supportive of this other trend that some other broader equity analysts have actually pointed out, that the mid-caps in India might actually see more upside or potential upside as compared to some of the bigger players in the Indian market?
No, definitely. I think the mid-cap players, particularly who are executing well, like Persistent, like Coforge, and we saw even LTI Mindtree under the new CEO, Mr. Venu Lambu, have been doing pretty well over the last 6 to 7 months. So I guess that trend will continue in the near future as well, where if you look at, the AI impact on the legacy business, they are pretty agile and quick to make that hit happen very quickly in a matter of 2 to 4 quarters. And they are competing quite aggressively out there with the large cap players now, even for mega deals for $500 to $600 million mega deals. So clearly, as and when those deals hit their revenues, we can see a big uptick in their overall revenue momentum. And also to highlight, since 2017-18, actually for the last 8-9 years, we have seen the overall contract sizes have been shrinking. So rather than having large deals, we are having long tenure deals, which means the deal duration and the deal sizes are shrinking. And that is creating a level playing field between the mid-cap and the large size operators. So in that case, if the management is quite aggressive, they are able to increase their capabilities around hyperscalers, the key SaaS companies, and the overall ecosystem which is required to build AI applications, then those companies can do really well. We have a very high conviction outperform rating on Persistent, where we see the highest set of capabilities around all these ecosystem providers. And no wonder they have 4.4% sequential growth in this quarter with a $2 billion revenue vision by FY27. So yeah, I agree. I mean, these mid-cap players should continue to do well. And also, mind you, they're operating at a lower margins. So clearly they can play a pricing game as well out there apart from capabilities.
Sumit, you mentioned something I want to go back to, and that's that order sizes, or at least some of the orders that are being won by the IT providers service providers in India, seems to be getting smaller, and the duration of these contracts also getting shorter. What kind of volatility is that introduced towards their margins? Because based on my impression is that you're going to have to work doubly hard actually to try to win more orders to make up for the smaller and shorter duration orders there. Again, what kind of margin pressures is that going to put on on these IT service providers, whether they be big or small?
No, yeah, clearly, I guess if you look at their sales and marketing spend for the last several years, that has been pretty elevated. And whatever margin levers they talk about, that will largely come through G&A optimization or an increase in offshoring or deploying more freshers. But on the sales and marketing side, the investments have been only going up, and that I guess that trend will continue. And if you look at some of the players like Coforge, after the current CEO came in 2017-18, he actually quadrupled the sales incentives. Now that has led to a mid-teens kind of order book CAGR for them over the last 7-8 years. So companies who are giving a huge incentives to their sales and marketing team and are pretty aggressive on their sales and marketing engine are doing extremely well. Now, if you recall, when Salil Parekh joined Infosys back in 2018, in 2019, they made huge investments on their sales and marketing engine, and that helped them to revive the mega deal win trend. So I guess clearly this trend of deal shrinkage will have an impact on higher sales and marketing spend, and that will be a sort of a margin drag going forward as well. But of course, companies have various other levers, as I talked. So overall, we believe in the AI world, where revenue per employee can continue to pick up, the margins on an overall basis should be manageable.
All right, Sumit, let's talk about the one, I guess, drag or concern that people have with regards to Indian IT services. And that's that H-1B visa hike, the fee hike, which really caught the attention of many around the world because about 70% of these H-1B visa holders are actually Indians or South Asians. How serious is this really? Because a number of Indian IT firms like Wipro have actually said they've now trimmed or limited the number of H-1B visas they're employing out of the United States. And with the exception of, say, Tata Consultancy Services, not a lot of Indians firms might actually be having H-1B visa employees onshore in the U.S. Can you help us understand why why this is still a big risk, if it is at all, for the Indian IT sector? Or do you think that the risk assessment might be a bit overblown?
Yeah, no, clearly we don't see a huge risk to the earnings of the IT service providers because of H-1B visa concerns. I mean, if you look at in the last 7-8 years since 2017, they have reduced their reliance on H-1B visas quite materially. The overall fresh applications for H-1B visas have come down by 60 to 80% for almost all the large Indian IT providers over the last 7 years. And there are multiple risk mitigation strategies they have adopted in terms of focusing on local hires in US, opening up nearshore sectors in countries like Canada, Mexico, Latin America, and also trying to offshore more amount of work to India. And by the way, COVID in a way had been a boon for these companies in terms of increasing their offshoring effort over the last 4 to 5 years. So I guess H-1B visa is not a huge risk for them, but yes, one thing we need to keep in mind that the US administration have also advised to clear those H-1B visas which have a higher salary grade. So in that case, the H-1B visas may not be issued for the entry-level engineers who have a huge ambition to move to US in a matter of 2 to 4 years after joining these firms. So apparently H-1B visas will be applied for more mid to senior level employees with more than 100 to 150,000 US dollar annual salary. So yeah, we don't see it as a huge risk. It's more sentimentally negative, but not so much as far as earnings of these companies are concerned.
I think one of the reasons we're also talking about the H-1B visas also is that we might see a reverse brain drain actually in India if a number of these H-1B visa holders come back. But we are also noting one concerning trend in the IT service sector, and that's attrition or job losses. A number of companies, big ones in fact, have started to cut back over the last couple of months in terms of the size of their workforce and headcount. Is the worst over actually with regards to this? Or could we see more companies rationalizing the size of their workforces, thus posing perhaps even more, raising more questions with the IT service sector and perhaps even putting more strain on the employment or labor pool out in India as well?
No, yeah, definitely. I think it's a genuine concern as to how would be the growth for IT services sector as far as employment is concerned. Now, we are seeing over the last 2-3 years, the revenue per employee has grown at a material pace, implying that the headcount growth has been pretty muted. And part of the reason for that can be attributed to increase in the utilization of employees for these firms in the last 3 years, where they overhired, if you remember, post-COVID during calendar 21 and 22, and then they had to optimize in the last 3 years. But having said that, we are seeing a material improvement in revenue per employee of these firms in the recent past, and that's the trend going forward as well. So we will not be very surprised if, let's say, the Indian IT sector growth is mid-single digits, but the headcount growth might be low single digits. So that can have some sort of negative implications for the IT employment. And yes, I mean, also just to highlight, the captives have been growing pretty fast in India. So that should be able to offset some of the negative impact of headcount growth in some of these large Indian IT service providers.
And what kind of impact would the adoption of artificial intelligence have on some of these attrition rates, and perhaps even in terms of how it might help some of these companies optimize? Because everyone's a bit split as to whether that AI will actually mean more support for IT employees in India, or perhaps a replacement of IT employees in India. What are your thoughts there? And are the risks here a bit overblown, or something they'll have to take seriously, maybe not this year, but maybe in the next 3 years?
Yeah, I guess there is a lot of narratives moving around, how AI will impact the IT services sector globally. And what we are seeing, there are two ways it's impacting. One is, of course, you have the deflationary impact on your existing service lines, including coding, including infra management, where a lot of work, particularly at the entry level, can be automated by using AI tools, including coding applications. And then on the other side, there is a new amount of work coming up in terms of stitching the complex technology stacks to build Gen AI applications. So Infosys called about, launching 4 new small language models. One is in banking space, one in IT operations, one in cybersecurity. So, as AI is being infused across technology stacks, where we have already seen benefit coming to semiconductors as well as to hyperscalers, and to some extent SaaS companies as well globally, where they are all launching AI agents. Now, at the end of the day, you need Plumber to actually implement those solutions. So there is an incremental volume coming on the back of this new wave of technology. And that's where, different companies are having a different kind of revenue growth profile, where if they are proactively taking a deflation on their existing service line, but taking on more wallet share from their clients, they are actually not seeing a huge deflationary impact on their revenues. And the order books are actually expanding. And I believe, this impact of AI will happen probably over the next 5 to 10 years, not immediately. And that's where the IT service providers need to be more proactive and more aggressive to infuse Gen AI in their delivery solutions more proactively and make sure they are gaining wallet share in the client IT outsourcing budgets.
And definitely something that could transform or perhaps storm the industry in the next 5 to 10 years when AI really starts to pick up more steam. But we'll have to wait until then to really see what the overall net impact might be. Sumit Jain from CLSA India, thank you so much for joining us today and helping us better understand how the IT sector in India is shaping up, especially with regards to the recent headwinds that have besieged this particular space in India. Well, coming up, Indian markets have joined the trading day and some big earnings still lined up today. We'll be back with all the details in about 2 minutes. Stay tuned. You're watching Inside India. Well, 5 minutes into the Indian Friday trading session, and the theme song today is Lean Back. Take a look at the Nifty 50, just down by about 0.1%, just easing off of that two-day winning streak. Of course, perhaps it's just trying to find its footing so far, but still like a very slight tinge of red. The Indian rupee, though, still looking strong today and also flexing once more to 87.77 against that weaker U.S. dollar. Now, we have a big report card lined up. Reliance Industries will be reporting its second quarter numbers later today. It is the largest Indian company by market cap, with analysts estimating Reliance to see an 11% jump in net profits led by its oil to chemicals and telco businesses. The stock right now for Reliance up by about 0.7%, and we're also expecting numbers from JSW Steel. Higher input costs are expected to weigh on the margins of the steelmaker despite strong demand. The stock ahead of the report card currently down by about 0.8%, mirroring the slight dip for the broader Nifty 50. They're down to about 1,170 rupees per share. Geo Financial Services also reporting a 41% year-on-year jump in quarterly revenue to around $112 million for the second quarter of their fiscal year 2026. The surge was driven by growth in lending, asset management, and payments. Net profit, though, remained nearly flat around $79 million, while operational income rose fivefold to about $36 million. And that surpasses the treasury gains for the first time. The stock, though, looking a little bit more subdued, but now trying to make a run higher, up by about 0.8%, 312.5 rupees per share. Now let's check in on the shares of IT firms Infosys and Wipro, which are reacting to their earnings report card the other day. And we take a look at Infosys and Wipro matching declines, but Wipro really taking it on the chin, falling and plunging by more than 4%. Let's start off with Infosys, though, narrowing its revenue growth forecast to about 2 to 3% for the year, even amid a challenging macroeconomic environment. Its financial services and manufacturing verticals performed strong in the last quarter, and their stock is down by about 1.4%. Now, for Wipro, they also beat revenue estimates around $3 billion in quarterly sales, driven by growth in Asia and the Americas. And Eternal is looking like this, and right now trading about 3.3% in the red. The parent company of Zomato and Blinkit posted a sharp rise in quarterly profit. Still, margins are at Eternal still remain under pressure as Blinkit continues to spend heavily on marketing and store expansion, now targeting more than 2,100 locations by the month of December. They're down to about 336 rupees per share now. Air India, meanwhile, is gearing up for a major expansion ahead of the winter travel season, adding 174 new weekly flights to its domestic and regional networks starting October 26. Under its northern winter schedule, the Tata-owned carrier plans to strengthen connectivity between India's major cities in Southeast Asia, while boosting access to popular tourist and Tier 2 destinations across the country. The airline says rising passenger demand ahead of the holidays is the reason behind the expansion of routes. And the Diwali festivities are kicking off this weekend in India. The auspicious day of buying gold and precious metals will be celebrated tomorrow. Markets are gearing for a rush of customers, but record high prices could dent some of that. Over the past week, we've spoken to multiple people about this gold rush and where it's headed. Let's take a listen.
And I think it could go to 5,000 by the end of next year, if not sooner. And then beyond that, I think it could get to 10,000 by the end of the decade, by 2029. Now, again, I just said that there's really no way to value it. There's no way for me to, 100% show you the math behind getting to 10,000. But there has been an interesting kind of trend relationship between the S&P 500 and gold. They tend to, over time, kind of head in the same direction and get to the same levels. And I think S&P 500 can get to 10,000 by the end of the decade based on earnings and a relatively high valuation multiples. So if that happens, I think gold can get to $10,000 per ounce by the end of the decade, 10 in 2029.
We have on the base case 4,200, which probably now we're inching more towards the upside case, which is $4,700 an ounce at this point in time. That does come with a modest decline in the dollar. When it comes to exposure, I think we do, from our perspective, basically just be outright exposed to gold, alternatively for those who have the ability to take much more risk and look for some of these gold miners that is also expected to perform pretty well in a rising gold environment.
It's a risk-off asset that has broken its correlations for good reason because of what's happening to the view of sovereign U.S.
So you think it is a debasement trade, so to speak, that's leading to gold?
Yeah. Look at the amount of inflows into our stock market from outside that are hedged, dollar hedged. So people love U.S. companies. They don't like the dollar, so they're hedging that. I think the other issue you've got to be concerned about is the decoupling. Low-income household from middle and upper-income household, that's a decoupling. The labor market from growth, that's a decoupling. So below the surface, there's a lot of question marks that suggest that we've got to be careful in the months ahead.
Precious insights on the precious metal. Well, that's all the time we have today on Inside India, but do keep watching CNBC, and that's because Access Middle East is coming up next. Have a good Friday and have a good weekend ahead.